All right, welcome everyone. Welcome to our first webinar of 2022. So for 2022, we're going to look back at 2021, and we're honored to have Brett Greenspan today presenting, reviewing last year and talking about what we're looking at ahead. We were just talking before going live here with Stephen Geiger, who's also joining us from Morningstar today, about the recent volatility in the market. So I'm sure many of you have signed up or are attending today to maybe hear a little bit more perspective about that. So we'll certainly talk about that as well. And I just wanted to do a quick thank you for Brett and Steve for doing yet another webinar with us here. It's certainly a great value add for our clients or those of you that aren't clients that are just simply on our email list. Glad you could join us. Hopefully it gives you some good perspective to the markets and helps you with your long-term planning. So with that, I'm going to switch it over to Brett and let him jump right in.
Thanks, Josh. Always appreciate the collaboration with you. And good afternoon, everyone. Appreciate you joining us today. There's a lot to discuss. For those of you who are familiar with Morningstar, I'll have a bit of a refresher for you as we get started here. For those of you who perhaps haven't heard of Morningstar, hope you find this informative and certainly happy to provide you with any additional information that you're looking for. I am going to share my screen here. So Josh, I'm going to rely on you to just let me know that you can see what I'm sharing. If you could give me a thumbs up. All good. Great. All right. So as Josh mentioned, just going to do a bit of a year in review for 2021. There's a lot to discuss, mostly positive, right? At least with respect to the market. Certainly our day-to-day lives have been nothing but uncertain for the last really, approaching 2 years now. But with respect to the markets, pretty stable year, which we'll discuss. We'll go over some high-level review of the capital markets, focus on equity and fixed income before we turn to 2022 and our outlook from there. And we should have plenty of time at the end if you do have any questions. But I did just want to give a bit of an overview on Morningstar. And looks like I fell out of the view I wanted to be in here. So give me a moment here. There we go. Morningstar, I'm part of Morningstar Investment Management, which is a subsidiary of Morningstar Inc., primarily known for our independent research. But the group I'm a part of is Morningstar Investment Management. We're a global organization headquartered in Chicago, but we do have offices in Australia, China, India, UK, South Africa, with, as you can see on the screen, over 600 employees and just shy of 100 investment professionals working on managing portfolios. And so we really feel that we've got a global organization that can provide a lot of value here. And I hope that you find some value in some of the research and insights we provide today. So, before we get into 2021, I always think it's important to kind of set the stage for really what was the last inflection point in the markets. And that was the first quarter of 2020. And just a reminder, because we've seen such tremendous growth over the last really 18 months about where things stood at the end of the first quarter. And if you can just put yourself in that headspace, the amount of uncertainty, anxiety about what was to come, I can tell you, I live in the suburbs of Chicago, but at that time I was living in the city and it was basically, well, we might be shut down for 4 weeks, 6 weeks. We could even be shut down and then it'll be back to normal. And boy, that could not have been more wrong. But in the markets, it was really red just about across the board. S&P down 20%. Some of those areas of the market with more volatile balance sheets, small caps, mid caps, down 30% in some cases. And it wasn't any better internationally. Just really a bloodbath across the board. But over the next 18 months, a pretty dramatic turnaround. If you look from April 2020 to the end of last year, the market and specifically the S&P 500 was up almost 90%. It's hard to fathom that. That is such a huge turnaround, a 90% return for the S&P 500. And that was primarily led by growth stocks, right? And specifically some of those large cap growth stocks. But with respect to the recovery last year, you also saw some participation from small and mid caps. Now, one thing I will point out, a key theme to remember is that the US has really outperformed international equities over that time, and it hasn't been by a small margin. if you look at those from second quarter 2020 to the end of last year, you're talking about, really a 30 to 40% difference between developed markets internationally and what we saw in the US. On the fixed income side, it was really a risk-on play, and you can see that backed by that high yield performance leading the way in the fixed income space. High yields over that same time horizon up just shy of 30% there. So just a reminder that this has really been a multi-year theme, and after the first quarter, we've had pretty tremendous and mostly one-directional growth. Now, if we look at 2021 in isolation, a really, really strong year. If we start at the top, you can see the S&P 500 up just shy of 29% on the year. Now, one thing I want to remind everyone, and I'll touch on this a bit later, is that it was a really low year with respect to volatility. I saw an interesting data point that said the peak to trough drawdown in 2021 was a little over 5%. It was 5.2%, which ranks in the bottom 10% over the last 90 years. So think about that. That was really a tremendously one-directional market. And just a reminder, and obviously I think this is pretty timely given what we've seen to start the year in the markets, that we're not likely to have years like that where the market is up in a one-directional way. It's far more likely that you'll have some significant drawdowns, some peaks and valleys. And it's more important than ever to remove emotion from your investment decisions and just know that this is not something that's supposed to be easy money, right? There's supposed to be some volatility involved. And it's healthy. It adds to the efficiency of the markets. It offers price discovery and allows the market to properly value individual equities, sectors, and asset classes. Now, with respect to 2021 performance, a continuation of some of the themes we've seen, right? With US large caps leading the way, followed by mid caps, followed by small. But one thing I do want to address is that certainly compared to 2020, the difference between US growth and US value was within 1%. We're basically neck and neck. Now, if you looked at 2021, that gap between growth and value was close to 45%. And that was driving a lot of the performance. And you'll see on some subsequent slides here that some of those mega caps, those FANGM companies, were really leading the way. So for those that are more value oriented, I think it made a lot of sense to see US value close that gap. We tend to see value stocks perform well in cyclical or recovery environments, and that's what we saw last year. Now, internationally, again, a continuation of the theme.
I'm going to interrupt you for 1 second.
Oh, please.
Rewind you back here. Just give 2-second overview of, difference between value versus growth, maybe for those that haven't been on our webinars before or aren't quite as versed in capital markets.
Yep, absolutely. So value stocks are going to be your companies that are perhaps a bit more defensive. Maybe their price to earnings ratio is a bit lower. They tend to be a bit more stable. So maybe lower growth, but more stable returns. Whereas those growth companies, as the name would indicate, are growing at a faster rate. Perhaps their balance sheets are maybe less strong, but they offer more opportunity to the upside. So when you talk about growth companies, maybe think about some companies in the tech space or communication services. When you think about value companies, think more about maybe your financial services companies, some of your energy companies. I think that's an easy way to kind of wrap your head around what that might indicate. Now, I do want to just briefly touch on the international markets. We saw a bit of a laggard here relative to the U.S., still in the positive for some of those developed countries. But we did see negative numbers in emerging markets, and that was primarily driven by some of the volatility that we saw in China. Chinese equities have had major volatility issues with some liquidity issues over there. There's also obviously the ever-present fears about government intervention and regulatory issues. So not a great year to be overweight emerging markets. And on the fixed income side, again, given the outperformance of equities, this was more of a risk-on trade. And so again, you saw high yields outperform. Not a ton of return in US governments and corporate bonds, and a similar environment if you go a bit higher on the risk table there with some of that emerging market debt at the bottom of the screen. Now, always important not to get caught up in short time horizons. So if you look at the trailing 10 years, a really good time to be an equity investor. 16.5% annualized returns for the S&P. Again, primarily driven by large caps, but you can see that if you stretch out the time horizon to 10 years, that gap between large, mid, and small gets a bit more narrow. So it was still beneficial to be overweight large caps, but there were certainly positive returns, a lot to like about being in the mid cap and small cap space. But really since 2010, you've seen U.S. growth dramatically outperform U.S. value, and at a really high level, U.S. equities outperform international equities. Now, this is one more chart that I think really drives home the challenge of trying to pick winners and losers in a given year. This is a chart that shows sector performance and asset class performance, with that dotted line or that black line you see tracking how a balanced portfolio would do going back to 2006. And what you can see here with this mix and match of colors is that it's very challenging from one year to the next to say what's going to perform well. You rarely see a shaded box here that's primarily in those top three rows at the top year after year. So just a reminder that being a balanced investor, you're likely never going to get too high or too low. And so for those of you who maybe don't like the roller coaster of investing, just a reminder that being in a balanced portfolio can certainly allow you to participate in some of this outperformance in the markets without dealing with some of those significant drawdowns that you see on a 1 or 2 year basis. So Josh, I threw a lot out there. I'll just pause. I see we've got a couple questions in the chat here. I want to make sure I address those if they are for me. Oh, looks like they were from you, Josh. Okay, so we're all good here. All right, I'll keep moving here, and I do want to focus on equities in particular. And really just show you a style box breakdown of what the returns looked like in the US equity markets last year. And again, this was a tremendous year for equity markets. Starting in the large cap value space, I mentioned that returns were basically neck and neck with large cap growth. You'll see on an upcoming slide here, a lot of this was led by the outperformance of energy and financial stocks at the sector bit level. But you also saw increased participation, increased upside from mid caps and small caps as well. Now, the only place that tended to underperform rather was small cap growth. You could point to any number of factors, hard to pick a specific one here, but really it was a year of value, right? You saw some of these cyclical companies, cyclical sectors bouncing back from that pullback in the first quarter of 2020 to continue with some outperformance as we see a recovery from the broader US market. So really not a ton to be upset about. And from a sector perspective, this was really led by the energy markets. For those of you that are out there traveling again, driving a lot, you've certainly seen gas prices far higher than they were over the last 2 years. A lot of that has led to pretty significant energy outperformance. You also saw financials come in at 35% within the US financial sector, really strong return. Those are two areas that were beat down pretty badly in 2020. So a bit of a 180 there for energy and financials. What we had seen in 2020 was a pretty significant outperformance from some of those FANGM tech and comm services sectors and some of the individual companies in that space. And information technology continued the trend there. Really strong year, just lagged financials. Comm services pulled back a little bit there, but all in all, you saw the returns for the S&P 500 at just shy of 29%. So it should be no surprise here to see a lot of really strong numbers here from individual sectors. Really the lowest performers on the far right there in utilities and consumer staples. Now, FANGM stocks are always a hot topic, and I do want to address this. And for those of you that, maybe you've got Squawk Box or CNBC on this morning, certainly you saw some of the news about Netflix reporting earnings and down about 20% today. And that just speaks to, one, the run that they've been on, and two, the potential drawdown risk with where some of these valuations are in the market right now. It's a double-edged sword, right? If you've owned those companies, you've certainly benefited, as you can see here, from some of their long-term outperformance. But it does create some drawdown risk if some of those long-term projections about earnings and cash flows come in under estimates or come in below expectations. So this is a kind of busy slide. So let me walk through it here. So what you're seeing here at the top, that blue bar or that blue line is going to represent Facebook, Amazon, Apple, Netflix, and Google. That green is going to be the information tech sector as a whole. Then you can see the S&P 500 and then an equal weight portfolio. Now, it's easy to look at this and say, wow, you know, the S&P really lagged here, but we're still talking about north of a 100% return. And I think the better framing is just how incredible the performance of these FANGM stocks have been. And I say FANGM, this is showing FANG, but you could throw Microsoft in there as well as a company that's had significant outperformance and ranks in the top 10 in market cap for the S&P 500. So just a reminder about how this looks with appropriate framing. You know, since 2017, a 365% return for those stocks relative to the S&P, which is no slouch, but well below that at over 100%. Now, that's some kind of raw data about the performance of the portfolios. This is another chart that I think does a good job of illustrating how high valuations are within the US relative to its own history. So this is a data point. It's called the Shiller PE, and it's the cyclically adjusted price to earnings ratio of US stocks. So it takes a 10-year rolling return. So it tries to strip out some of the noise from year to year valuations and performance. So it's a 10-year rolling return. And this goes back almost 100 years to 1928. And what you can see here is that within the US, we're at the second highest point in history, only behind the tech crisis in the late 90s into 2000. So, you know, I want to caution, you know, this is one data point. Obviously, it's not an apples to apples comparison to say, you know, well, if this is what it is right now compared to, you know, the late 1920s, you know, those are the same market conditions. You know, we're going to talk about a lot of the changes, certainly from a monetary policy, from a fiscal policy. So this is not something you just say, I take, you know, the market must go down, but it's certainly informative of the fact that we're seeing prices as expensive as we've seen it in quite some time. Now, the other side of that coin is perhaps it creates some opportunity in specific areas of the markets. And, you know, one thing we talk about at Morningstar is investing with granularity, you know, looking for particular opportunities, not painting with too broad of a brush, just because a market may be expensive from you know, a bird's eye view at the overall level, doesn't mean that there's not opportunities out there for investors. And what this chart shows is rather than just US growth and US value, this shows world growth relative to world value stocks. And you can see that, you know, they're never totally hand in hand, but they tend to trade pretty close to one another, right? So excess returns, call it plus or minus, you know, 5% in any direction. And what you can see here is that we're at a historical extreme between world value and world growth on the right side of the screen here. And perhaps that creates an opportunity for investors to say, okay, you know, maybe I've participated and benefited a lot from the outperformance of growth relative to value. But if we do see a convergence toward the mean here, towards historical averages, it's likely that you might see some value outperformance relative to growth. So just a reminder that you know, there's a lot of data out there. There's a lot to take in and digest. But you always want to think about, you know, just because this has performed well, perhaps that creates opportunity for something that's been out of favor to narrow that gap and to get back in favor. Oh boy. So all in all, again, just getting back to that point I was making earlier about granularity, our colleagues on the Morningstar Inc. side view the U.S. markets as trading at a premium of about 5%. You see in that top right, that 1.05 figure. Primarily, that's due to some of those growth stocks being a bit more expensive than what we view as their fair value. But that's not to say there's not opportunity out there. Specifically, small value, mid value, and large value look attractive to us from a price to fair value perspective. Some of that core area, and then you get into that growth space, a bit more expensive. But for a diversified investor, you'll likely participate in all of these areas of the style box, but it might require a bit of tilting to get exposure to those areas that we view as more attractive over the long term. So I'll pause there, Josh. I see a couple of comments in the chat here. Just want to make sure I do address those if they are for me.
Nope, I think we had one individual ask about slides. So of course we always need to make sure that those are approved by compliance. But
Yep.
anyone that wants a copy of the slides, feel free to throw that in chat, and I'll keep a list of the names and make sure that you get a copy of those once they are approved. You know, certainly a lot of data in there, so sometimes I know for me, I'll look back at them and think through what that might mean, or it's good conversation piece for others interested in capital markets as well. So if you want a copy of those slides, just let us know. As a reminder, we do record this webinar as well. So if you were registered, if you have to run before we finish today, I will email out a link to the recording later today or early tomorrow.
Great.
Hey, Brett, before you go on, hi, everyone, this is Steve Geiger. Could you tell everyone why you spent, time, why we at Morningstar spend time on the past, right? We just looked at 2020, 2021. How does studying the past fit in our investment process? Because obviously we're looking to manage portfolios from today forward for clients. So how do we incorporate that data that you just shared in our investment process?
Yeah. Thanks for the question, Steve. I mean, I think the easiest way to answer that is that we're valuation-driven investors, and to consider prior valuations is a core component of our portfolio construction process, right? One thing that I think it's often easy to do as an investor, and I'll say this, it's a challenge for me, challenge for everyone, I think, is to look at past performance and not build your portfolios based solely on what's done well in the past, right? There's an analogy I like. Perhaps it's a little cheesy, but I'll say it anyway. And it's, you don't want to look through the rear view mirror. You want to look through the windshield when building your portfolios. And it's more about, not so much what has happened, but what's likely to happen given what has happened. And so that's really what we're trying to do here, is say, okay, let's look at what the historical valuations have been here for a particular sector or asset class. How attractive is that on a relative basis versus the other opportunities set out there? And is perhaps there an opportunity for something that has been out of favor, has not participated as much, for us to see some of that, call it regression to the mean? So that's really a core component, is not so much this has done well, so we're going to build our portfolios based on that. It's, this has done well. Maybe that creates an opportunity for something that hasn't done well, and we should tilt our portfolios in that way. So without painting too broad of a brush there, it's a core component, but one component of our process in terms of portfolio construction.
Thank you.
So I'll give an update on fixed income as well. Forgive me if this is not as bullish or not as positive as what we just went over on the equity side, because it's been a bit more of a challenge in the fixed income space, and that's primarily been due to what we've seen with historically low yields. So within the U.S., we see that the 10-year U.S. Treasury really at historic lows. This is through the end of the year at about 1.5. We've actually seen that creep up a bit. And what this does is create an environment where there's not a ton of benefits to being in U.S. fixed income, right? So for those of you that maybe are a little more unfamiliar with the fixed income space, generally rates and prices act inversely to one another. So if rates go up, the price of a bond is going to go down. And with rates at historical lows, it doesn't leave a ton of opportunity for rates to go lower and prices to go higher. It creates a lot more opportunity for rates to go higher and bond prices to go lower. So broadly speaking, you can view fixed income right now as relatively unattractive. It's perhaps more of an area where you can be a bit more defensive versus equities, but not a ton of opportunity for income, not a ton of opportunity for upside in fixed income. Again, I'll get back to that point that it's not totally valid to say that about the entire fixed income landscape. We at Morningstar find the middle of the yield curve as an area where the risk reward tends to be a little bit more attractive right now. But broadly speaking, I can say at Morningstar, within our asset allocation portfolios, We're a little bit underweight fixed income. We're underweight duration, which would be a reflection of interest rate risk. So we don't have a ton of conviction about long-term outperformance in that space. So we're moderating our risk there. We're reallocating into other resources like alternatives, which can check some of the same boxes as fixed income in terms of lowering correlation, maybe providing a little bit of income. But broadly speaking, it's a relatively unattractive environment right now. Now, I touched on earlier some of the high yield outperformance that we've seen going back into 2020. And this chart does a great job of illustrating that, right? You can see here, we're looking at the spread between high yields and more investment grade. And that spread spiked in a huge way in 2020. And that makes sense when there's a ton of uncertainty about the markets, about the stability of balance sheets. Yields are going to go up, prices are going to go down. What we're seeing right now is that spread has narrowed quite a bit. In fact, high yields and investment grade are trading actually below the average spread going back to 2013. So another reminder that it's a really tough environment to find income, even in the high yield space, and requires a little bit more appetite for risk than you might normally find in a more traditional market environment. Now, one space that we do think that the risk reward is a bit more attractive is in emerging market debt. Again, you will be required to take a bit more risk in that space, but with that risk does come additional yield, a potential for additional upside there. So that's one area that we have allocated a bit to in our asset allocation portfolios. We do think is relatively more attractive from a risk reward perspective. So I'll pause again here. Yep.
Yeah, Harry did have a question. I don't think it was in any of your prepared slides, but he was inquiring if you would be covering anything about structural notes, public REITs, or other alternative investments.
Yeah, I didn't prepare to cover that today. I will say, we don't offer structured notes, so I have to be a little cautious about how I speak about them. But I can say that I know that they do, certainly serve a purpose for investors with specific needs, or allow the ability to structure some risk in terms of limiting upside or downside depending on what you're trying to accomplish. So from that perspective, I don't have a ton of insights with respect to our offerings at Morningstar, but I do know that structured notes can certainly offer benefits and perhaps allow a bit more tailoring than maybe a traditional, say, fixed income ETF or mutual fund. In the alternative space, we have allocated a bit more to alternatives in some of our mutual fund portfolios. We've got a Morningstar mutual fund that has 3 sub-advisors that we use for alternatives. One of them is BlackRock, which is they run a credit-oriented sleeve. SSI and Water Island run a convertible arbitrage and a merger arbitrage sleeve as well. Alternatives just generally, they tend to lower correlation with traditional equity and fixed income markets. There are environments where they'll be more active and able to generate kind of outsized or excess returns. But broadly speaking, I think the best purpose they serve in a portfolio is just to add some lower correlation to some of the other components that you have in a more traditional lineup.
Brett, can I rewind you there? And can I have you expand a little bit more on the arbitrage part of that alternative sleeve?
Sure.
So I think when you say that, people say, oh, okay, I don't know what that means at all. So, high level, of course, you don't have to get into a ton of details, but maybe a simple example would help.
Absolutely. So with convertible arbitrage, generally the idea there is that these companies, these managers are exploiting an opportunity to buy, say, some fixed income securities that can be convertible into equities. And if the market hasn't fully priced in or fully recognized, a potential difference in price or difference in value between the price of the fixed income security and what that would convert into in terms of equities, there's an opportunity to exploit the differences there and profit from it. Now, with merger arbitrage, it's somewhat similar in the sense that a merger is announced between 2 companies, And what these sub-advisors will, or what these managers will do, are running a merger arbitrage strategy, is buy one company. So I believe they generally are buying the company being acquired, sell the company doing the acquiring, and profit from the difference in prices there. And there's some risk associated with that. Mergers often require regulatory approval. They, occasionally will fall apart as you get from the, to the 10-yard line, 5-yard line, 1-yard line. They don't always go through. So there's some risk associated with that, but that risk, can lead to mispricing and potentially create opportunities for some of these alternative managers to profit from it at scale. I hope that was high level enough, but if there are additional questions do come in, happy to provide more details on that.
Okay. I know Harry had put a follow-up there on that sort of going back to trying to catch the name of the Morningstar mutual fund that you mentioned. So let's take this opportunity to discuss what the Morningstar mutual funds are and sort of how those are structured and available to consumers or not.
Yeah, good question, and appreciate the interaction. So within our Morningstar asset allocation portfolios, we use, for one of these series of portfolios, we use Morningstar mutual funds. And right now, this is the only way that you can use these Morningstar mutual funds, is within a Morningstar asset allocation portfolio. Within the mutual fund asset allocation series, there are 9 Morningstar mutual funds that we use. Within these mutual funds, so stay with me here, because it can even be a bit confusing for myself, but there's these Morningstar mutual funds that we run. And within these mutual funds, we hire managers to invest a particular sleeve. So for example, I'll come back to the alternatives, but for example, within the Morningstar US Equity Fund, we hire ClearBridge to manage our large cap growth exposure. And we hire a company called MFS to manage some of our core and value exposure. So within these mutual funds, we hire companies to achieve a particular objective of to obtain our large cap growth exposure, to obtain our large cap value exposure, et cetera. Now, the names of the sub-advisors within our Morningstar Alternatives Fund, BlackRock is one of them. So BlackRock, a familiar name out there. SSI is another, and Water Island is the third. Now, I believe, if I'm not mistaken, these are institutional managers that I don't believe they offer retail mutual funds. They're hired to do exactly what they're doing for us, which is be institutional asset managers. But that is how the fund is structured, and those are the managers that we've hired within the alt space.
Josh, may I interject here? I want to
Sure.
go back to the about the REIT question and the structural notes. One thing to know with Morningstar is, liquidity. I mean, we have to choose investments, whether it's an ETF or a mutual fund or stock, let's say, that has, you could purchase it one day and you could sell it another day. Some of these structural notes don't have that same provision, right? Like, there was only certain times where you can invest and only certain times where you can pull the money out. So those are instruments that probably wouldn't find in our managed portfolios, because we need to have liquidity. I've seen in our individual equity portfolios, our managers use real estate investment trusts often, because they're publicly traded on the stock exchanges. So I see REITs used more than structural notes. Maybe some of our managers that Brett just described, like BlackRock and some of the other managers, they might have some structured notes in there in the portion that they manage for us. But I would think that it's not much, because again, we need liquidity. When clients give us money, we have to invest it that day. When they want their money, we have to withdraw it that day. We can't tell them, oh, you need to wait 2 months before it expires. You know what I mean? So very important to understand what liquidity means for these for the accounts that you work with your clients with and that you send to us, Josh.
Sure, certainly appreciated there. And I guess, from the planning perspective, certainly we do explore things that are not offered through our Morningstar platform as well. whether that's even things like life insurance or annuities or things, in the insurance realm more. So yeah, I guess the structural notes kind of fall outside of the scope of this as well. So just Brett, we'll let you get back. We got off on a pretty big tangent there, so
No,
let's
that was
signal.
that was a good one. I enjoyed I enjoyed that. But let's look forward to 2022. There's a lot to be excited about, and I don't know why I'm having such issues with my slide deck here. This part is not so exciting, but depends on the lens, right? What you're looking at here is new COVID cases. This chart runs through January 4th, and I think at this point, regardless of where you're located, the Omicron variant has been prevalent and present and affecting day-to-day lives. And, it came on strong and fast. I don't even think that was really on the radar around Thanksgiving. I could be mistaken. It's hard to really factor in time at this point. But really, it seems like this has almost come in such a huge wave over a 6 to 8 week stretch. This again is through January 4th. I can say that here in the Chicagoland area, they are saying that we have either just are peaking or are seeing a plateau near the peak. So there's some hope and some positivity here. That's the wrong word for it in this case, but there's some hope and I suppose bullishness that we're maybe through the worst of it. That as the peak does reside and we see these numbers come down, that perhaps we can get back to a bit more normalcy. But this has certainly played a part in the end of the fourth quarter into the first quarter, and it's likely going to continue through probably the rest of Q1 here. From an unemployment perspective, it's hard to say how much of an impact COVID has had since call it mid 2020. What you're looking here is U3 and U6 unemployment rates. U3 is the traditional employment number that's cited. U6 accounts for discouraged workers, underemployed workers, and you can see that number still a touch higher. But we've heard a lot about the labor market being really tight, that there's a lot more perhaps control from those looking for jobs than is normal in a traditional market environment. Wages have ticked up as a result. So this is just one other variable that the Fed has to consider in terms of increasing interest rates. One of their mandates is to get us back to full employment. I don't think they don't view us at full employment yet, and they're also juggling inflation concerns and tapering. So just another variable to throw in there and make things really challenging for the Fed in determining when to raise rates. But broadly speaking, I think 18 months ago, everyone would have been pretty encouraged by these type of employment numbers. And again, it's swayed a bit of power back to the consumer, back to the employee, where it typically resides with the employer. Now, you heard me touch on inflation, and I think that's really front and center for a lot of investors, for a lot of us out there. In your day-to-day lives, we've seen prices go up. This is a data point from November. We did see the December data points come in a bit higher, with CPI at 7%, core CPI, which is CPI excluding food and energy, come in at 5%. This has been a pretty big issue certainly for the Fed and for investors out there, right? It's something that we haven't seen in quite some time, is persistent and sustained inflation. There was a lot of talk over 2021 from the Fed and elsewhere that this was transitory. It was something that was going to come and go, and that really hasn't been the case. You can point to any number of reasons. I don't pretend to be an economist and say these are the exact reasons that we're seeing elevated inflation. I do think that you can really point to a supply-demand imbalance as a pretty key driver for what's going on here, right? Where people were staying home, they weren't doing much, so we were all locked down for a period of time. Supply went way down, and really it felt like in a matter of weeks, months, depending on where you live, things got back to normal and demand went through the roof. And there was a lag time there for suppliers, whether it's supplying manufacturing or inventory or the supply of workers at restaurants and retail. There was just a general lack of supply, and that certainly played a part here. I also think, I was reading something interesting about In terms of the supply-demand imbalance, demand really, kind of shifted from services to goods, where there was really a pretty dramatic increase in demand for goods, which has led to some of those issues, as well as there's a longer lead time to getting those goods in front of consumers. So there's a lot of different components here for what's driving inflation, but I think is hope that as some of those supply and demand imbalances normalize, as we get back to more full employment, kind of a stable work environment, that those should sort themselves out with time. Now, another component beyond just what we've seen from the Fed is the fiscal response to the pandemic. And what we saw in 2020 and actually in 2021 as well, as we revised this, is some of the largest fiscal stimulus since World War II. So this chart really does a good job of illustrating this is the US federal deficit relative to GDP. And you can see that this is a tremendous amount of fiscal stimulus, not on a one-off basis. This is going to look pretty similar in 2021 as well. So in back-to-back years, really historically large stimulus as a percentage of GDP. And that's large. That's likely playing a part as well in what we're seeing. So it's not just the stimulus from the Fed. It's not just the stimulus from the US government. It's this overwhelming amount of stimulus from both the Fed and the US government that's added a ton of liquidity into the markets. Now, a lot of that is certainly lifting the markets, and we've seen that play out with some of the real GDP growth both last year and what we're forecasting into the future. We expected U.S. real GDP, once it's finalized, to come in at about 5.6% for 2021. We had a slight revision down from 4% to 3.9% in our projections for 2022. And you can see those subsequent years still pretty strong. So we're a little bit above consensus through 2025, and I believe we are actually above our pre-pandemic estimates for the next 5 years. So pretty strong year with GDP growth. Again, there are some headwinds. If we do see rates rise, if we do see inflation become something that requires a bit more intervention from the Fed, that could certainly have an effect on some of those long-term forecasts. But all in all, a lot to be excited about for 2022 and beyond. So I just want to finish up here with a high-level outlook for what's to come. Again, Omicron is certainly front and center right now, but I think there is some hope that we are, if not through the worst of it, experiencing the worst of it right now and moving past it into Q1. There will certainly be continued fears about another variant that comes on the scene. Market volatility may increase if that is the case, but with more vaccine distribution, both in the US and abroad, and with Omicron's wild spread, perhaps some natural immunity, there is hope that could create some normalization. With respect to the GDP growth, you can see here some of those figures I just covered on the last slide. 3.9% is the estimate for 2022. And then just a recap of the US market. It may be overvalued at a high level. That Morningstar Inc. slide showed it about a 5% premium. We did see some of that being skewed by those mega cap stocks, specifically in the growth space. Those tend to be more oriented in the tech and comp services sectors. So again, that may be an area that's a little more expensive, may require a bit more selectivity among individual equities in that space. And then in terms of what we find attractive, smaller cap stocks, the value pretty much from large down to small, maybe a bit more relatively attractive than some of the other areas of the style box. And then at a sector level, energy and financials continue to look attractive on the heels of that strong performance last year. And then you just heard me touch on that granular positioning. It's something to really focus on when you're building portfolios, when you're evaluating portfolios of potential investments. And then lastly, with respect to interest rates, there was an expectation that the Fed may raise rates later in 2022. The most recent Fed minutes indicated that could move up as a result of some of these persistently high inflation numbers. Some speculation that may now be in March. And they have begun tapering some of the bond buying, but it's been a pretty slow pace. I think it's about $5 billion a month, so it's still quite stimulative, starting at a $120 billion level on a monthly basis. So That'll take some time to get that back down to neutral. It will be curious to see if they increase tapering prior to a rate hike, or if they do hike rates in conjunction with that tapering. So a lot of uncertainty there. We'll certainly be have our eyes on the next Fed minutes, which should be out next month, and that will inform a lot of the potential for the rest of the year. So that is my content in terms of the slides, Josh, but happy to take any questions if we do have
Brett,
any.
can I have you jump back to your slide? And if anyone has any questions, please toss them in the chat function. We'll be happy to address them here. I wanted to talk about or highlight a little bit more this potential pitfalls of index-based market-weighted approaches. So I think, as you mentioned with Netflix here, this might be a really good example to help put that into perspective. So with the FANGM stocks being such a high weighting of the S&P at this point, could you talk about kind of that impact a little bit of maybe one player like Netflix? I think that's a really important point for people to think about, since those have been the stocks that really have been carrying the market, probably making us all quite happy in the short term.
Yeah, that's a great question and a great point, Josh. So at a high level, what we talk about when we say an index like the S&P 500 is market cap weighted, what we mean there is that the 500 or so constituents are not 1/500th of the index. It means that the larger companies make up a larger component of the index, and therefore their performance. So when we talk about the FANGM stock, so again, Facebook, Apple, Amazon, Netflix, Google, and Microsoft, those companies, because they are so large, at this point make up, depending on the day, it probably is a little less today, but call it between 20 and 25% of the S&P 500. So really what it does is it turns the index into a bit like of a momentum investment, where the biggest companies are performing well, so they get bigger and they're more impactful on the overall performance of the index. And it's kind of this self-reinforcing cycle where the better they do, the bigger they get, the better the index does, the bigger they get. And creates a lot of risk if a company like, say, Netflix or any of the other constituents has a significant drawdown. And again, Netflix is one of the components that we consider in FANGM. It's actually probably a little bit less. I think it's just outside the top 10 now in terms of the S&P 500. But say it was 5%. If a 5% component of the S&P 500 experiences a 25% drawdown, that's going to be impactful to the broader market. It's going to have an actual pull on the overall index. So I think it's important to be reminded about that, about how these indexes are constructed, and the importance of being broadly diversified and not tying your eggs to a basket where you think, I've got exposure to 500 stocks here, but actually you're really concentrated in these top 5 or 6, and the remaining 490 have far less of an impact or individually than those highly concentrated positions at the top. So today is a good reminder of that, with Netflix experiencing a pretty bad down day. That's not to say they can't bounce back the next day, but it's been a while since we've seen one of these big companies have a pretty big drawdown. And just a reminder that there's two sides of the coin, and this is the other side of what's been a pretty one-sided direction.
Awesome. Thank you, Brett. We also had, let's see, a couple more questions pop in here. So Debbie and John had said, your thoughts on sectors that have environmental pressures such as energy and plastics?
Yeah, good question. I can say with respect to energy that's an area that we are constructive on. Within our asset allocation portfolios, we do find energy attractive. There's a number of different ways to look at that, right? A lot of these companies have a built-in competitive advantage. I'd say energy and energy infrastructure especially are areas where there are very high barriers to entry, both from an infrastructure perspective, from a regulatory perspective, and it's also a resource that's finite, right? So that's one aspect of it that I suppose you could say is attractive. And on the flip side, these are companies, depending on your perspective and the pace they're moving at, you might feel one way or another, but they are transitioning or trying to transition more towards clean energy. Some of these bit larger companies are making significant investments in clean energy and trying to transition and add additional revenue streams for a future where perhaps there will be more regulation with respect to emissions and other components to protect the environment. I got to admit, I don't have a lot of intel on plastics, but for the energy sector in general, I can say that we at Morningstar certainly view it as an attractive space. We also find that in recoveries, energy falls into that cyclicals sector or cyclicals area, which tend to perform well in a recovery. So from that perspective, we find it attractive. It's also a sector that in high inflationary environments tends to outperform. So through the inflation lens, that's another reason that we like to have some energy exposure.
Okay, very good. And I'll throw in one more plug for our previous webinar that we did, where we talked about ESG investing. So Debbie and John, if the lens you're looking through is more, hey, maybe we're interested more in companies that are sort of leading the way, in reducing their environmental impact, that might be something to refer to, and we can have a further discussion from there. So I will shoot you an email with a link to the recording of that webinar as well, because I don't believe you were on that one.
Josh,
Steve, go ahead.
Just about the energy that Debbie and John had asked, because much like finance, I mean, there's different sectors within energy, like finances, for example. There's banks that lend money, and then there's and they're on the hook, if you will, for clients to pay the money back. Then you have your Visas and MasterCards, which really are the network processors, right? They just they skim off of every transaction. They're not actually at risk of a person, an institution not paying the balance back. They're just getting tolls. In energy, I've seen our teams maybe don't invest with the drillers or the producers of energy. They just own the pipelines. So whatever the price of natural gas or oil is kind of irrelevant in some ways to their earnings. They're more toll collectors as they distribute the pipeline, the energy to certain grids. So our team is very specialized in how they'll invest in that energy sector. And to your point about environmental, social, and governance, I've seen our portfolios really invest in those companies that Brett said are putting a lot of resources towards, like, net carbon of zero, renewable energies, solar, things like that, in the portfolios. So, but there's just, I just want to point out, there's a lot of different, in a way, there's sectors within sectors. And our company is very aware of that. And I know, for example, in one of our portfolios, a 6% holding is a distributor of energy, which pays like a 7% dividend, for example. So I'll stop there.
Okay. Yeah, fair enough. I think that, that the energy sector, any sector, there can be a lot more to dig into, and then evaluating, hey, how do we have exposure to this sector? The housing market over the last 12 months might be another sector where people say, oh, house prices are up. Well, Zillow isn't up. In fact, Zillow is down. So those individual stocks or areas of the sector can still be challenged. So anyways, I guess moving on to the next question, we had Harry kind of plug in. It really looks like he's looking at asset allocation overall. So he has 3.9 US GDP growth in 2022, suggested diversification into Europe and emerging markets, coupled with overweight US. Is that the way to go? Fixed income isn't offering much. So, maybe, Brett, maybe this is a good way to talk about your asset allocation overall, how you guys are kind of seeing overweight, underweight to different sectors of the market. With interest rates near zero and possibly ticking up, bonds don't seem to be a very attractive asset to many. So maybe specifically talk about bonds a little bit and foreign markets.
Sure.
But
Yeah,
general overall asset allocation.
There's a lot to unpack there because a lot of it is about framing and a lot of it is about what you're trying to accomplish, right? So generally, Harry, I think I agree with what you're saying. Diversification is the way to go. Certainly with an asset allocation portfolio. Now, you say coupled with an overweight to U.S., it depends what you mean overweight, right? So within our within our asset allocation portfolios, we have a home country bias. So in our aggressive growth, which is going to be pretty much the all equity portfolio, there's going to be more US exposure than there will be international equity exposure. But relative to the benchmark, we may be underweight US, right? We might have overweight to international equities with specific targeted exposures in a specific country. I can tell you that within our portfolios, we've targeted Germany as a country that we like to have exposure. Japanese equities, UK equities has been a good performer for us and one that we've taken exposures. So I think the point is that diversification is key. One year's top market is the next year's bottom market. It goes back to that. I think it's originally a JP Morgan slide, but that slide that shows the individual asset classes and their performance year over year. Now, on the fixed income side, again, as you said, and as Josh highlighted, it's not offering much. It really is about what you want it to accomplish in your portfolio. If you want it to accomplish capital appreciation, probably not going to be meeting your objectives. If you want it to, say single-digit returns as something that you don't feel comfortable taking additional risk in the equity markets, that seems like a more of a good fit. And within fixed income, again, maybe you don't want to just own say AGG, like a kind of a broad market ETF of fixed income securities. Maybe you do want to dig a bit deeper and own a basket of securities that reflects a particular part of the yield curve, where maybe you do find, the risk reward, you're getting, maybe less income than you want, but perhaps a little more upside and a little more protection from a rising interest rate environment. So within the fixed income space, frankly, it requires a little bit more expertise. And that's why, we rely on our fixed income experts, our portfolio managers, to do that deep digging for us and to add the appropriate exposures, for the amount of risk that us and our investors are going to be comfortable with.
Yeah, I'm going to jump back in on that too. I think, bonds, I think, for some clients, depending on how much, the purpose in your portfolio and when you're planning on using that money, there's a little bit more argument for keeping more in cash and less in bonds at this point too, in a rising interest rate environment, low interest rate environment as well. And, I know Harry in particular had mentioned alternatives there as well. Maybe a little bit heavier allocation into that alternative space may make sense depending on your individual situation as well. If anyone else has questions, feel free to drop them in here. I certainly appreciate everyone interacting today, giving us some more to talk about, to let us know what is on your mind. I will do a little plug for the next webinar I'm going to be doing here. So the other day this week, I was in the coffee shop near my office here and just trying to prepare some content to send out to y'all and think of some topics to talk about that are important to people. And I was fortunate enough that the two older gentlemen sitting next to me in the coffee shop were talking about their retirement portfolio. So I was polite and just minded my own business, but I can't help when they're talking about QCDs and Roth conversions. They're speaking my language. So, I took some notes and I thought, you know what? There's two individuals, and let's call one James. James was ultra focused on his retirement, knew really some professional level details in his own retirement planning. His friend, let's call him Robert, could give two hoots less. He hired someone else, and that was their problem. So my next webinar, I want to cover some of these things like QCDs, Roth conversion, some of these things that could make a pretty substantial difference in your retirement planning. I want to talk about it from two levels. We'll start out with Robert's level. So high level, why would I be concerned about this? Is it something I need to go to my financial professional about, or me if I'm your financial professional, and say, hey, are we doing this in my portfolio? Could we Could we improve my retirement plan in any way? And then the second half of that webinar, we're going to go to the James level. We're going to dig down into those details, maybe look at some individual scenarios. So if you have anything or any pieces that you've heard about in retirement planning that you want to learn more about, either from the James level or the Robert level, certainly shoot me an email. I'll be happy to add those to the presentation, and that'll be for February's webinar. So keep an eye on your inbox. You'll be getting an invitation for that one as well. Now that I've promoted something, as always, if anyone has questions or you didn't get a chance to say, hey, I want those slides, feel free to email me afterwards. I'll be happy to answer those questions for you, forward them to Brett if necessary, or send you a copy of the slides. I hope everyone's year is off to a great start. I thank you, Brett and Steve, for joining us today, and everyone for jumping on to get the recap of last year and what we're looking at moving forward.
Thanks for having me, Josh. Always appreciate it, and great to see you. And thanks everyone for joining today.
Thank you, Josh. Thanks, everyone.
Thanks, Steve.